Hey guys, in this video I want to compare the stock of Pfizer to that of Merck and see which one is a better value right now. If you're new to the channel, definitely hit that subscribe button. Check out more of my videos. We do a lot of stock analyses, a lot of investment stuff on this channel. But alright, let's get into it. Okay, so Merck and Pfizer are both drug companies, both operating in the healthcare / pharmaceutical industry. Pfizer stock is down about 6% for the year, leaving them with a market cap of about $205 billion. Their price to earnings ratio is 13, and they're yielding a little over 4% right now. If we compare that to Merck, they're down about 10% for the year. Market cap's about the same, $206 billion. They're yielding about 3.18%. And their price to earnings ratio is very similar, 13.65. If we compare the two companies' balance sheets, they're pretty similar, although Merck has a much higher interest coverage ratio, meaning they can afford to pay their interest expense much better, much lower risk of bankruptcy there on that metric. They have very similar liquidity ratios though. You know, the current ratio, that's current assets divided by current liabilities. It's about 1.4 compared to 1.3. Okay, pretty similar there. Not super safe, but neither company is at a great risk of going under. Here's a chart of revenues for Pfizer. You can see they're definitely not growing. They've actually been shrinking slightly for the past couple of years. Hate to see that. For Merck, it's pretty similar in that they're not growing much, but at least their revenues are not declining as compared to Pfizer. So you got to give the edge to Merck right now for growth. Alright, so here I'm doing a DuPont analysis where I break down return on equity or ROE into its three components and just compare both companies. And here you can see that Merck has a far superior return on equity, topping out at about 44% in the most recent period. I also like with Merck that is trending upward every year. That is nice to see, whereas with Pfizer, it's bounced around, but it's definitely not trending upward. What's driving this ROE? Well, I like to see for Merck there, they have increasing net income margins, so they're able to charge more and more for a given product. With Pfizer, we don't exactly have the same situation going on. You can see they had much better margins in the previous years. Both companies have fairly poor asset turnover. They're kind of asset intensive there. But, clearly an asset turnover of 0.56 compared to Pfizer's 0.29. That's almost twice as good there. And they both have leverage, yes, but leverage is not the thing that's mostly driving the difference in ROEs here. So Merck clearly has the better business. Is it the better investment? We're going to have to find out. Here we're looking at dividend information for Pfizer. This is one of the main reasons a lot of people are interested in these big pharma companies. They're great dividend growth investments. You can see Pfizer has a 5-year dividend growth rate of about 6.3%. They've been growing it for 11 years straight. They're yielding about 4.25%, and the payout ratio is 55%. So they actually have, about 45% of their profits for the year they can plow back into the business, meaning this dividend is quite safe. I don't think they're ever going to have to cut it, and they can probably continue to afford raising it for quite some time going forward. Now, if I compare to Merck, Merck has a slightly higher growth rate for the past 5 years. They've been growing it for 10 years straight. The thing I like about Merck is their payout ratio is much lower at about 43%. So even though they have the lower yield, they have greater potential for growth going forward. But, all in all, these two companies are actually quite similar on their metrics for dividends and their balance sheets. Okay, so at this point in time, what I'd like to do is try to estimate an intrinsic value for both Pfizer and Merck. I'm going to use the dividend discount model. These are both steady dividend paying companies. They pay out a pretty good portion of what they earn every year as dividends. So this is a great time where you can use the dividend discount model to get a pretty accurate fair value. Keep in mind, this model may understate the fair value because, out of all the money they give you as dividends, there's also extra profits they have they're not paying out. To the extent that they use that money to grow their dividend further or to buy back their shares, this could understate it. So it's kind of a conservative way to look at things. But that being said, I think it's the best model for this situation. So I'm going to use the Gordon dividend growth model, and let's plug in some numbers and see what we get. Alright guys, so here is the Gordon growth model. I got next year's dividend divided by the discount rate minus the growth rate in dividends. I've got their dividend for next year at $1.56, and I'm going to assume they can grow that at 2% a year forever. If that were to be the case, the fair value would then be $39. Now this model is quite sensitive to your assumptions, so if you want to use a higher discount rate, that's going to change the fair value drastically. That'll knock it down to about $31.20 there. Let's put it back at 6%. If the growth rate changes, that can also have a pretty dramatic effect. So instead of 2% growth, we'll just say 1.5% for Pfizer here, and that knocks it down to $34.67. In any case, even with more pessimistic assumptions here, I think you're going to see that Pfizer looks like a reasonable deal. The reason I say that is, again, the payout ratio for Pfizer, I believe, was around 50% or so. So this is really understating the fair value. Even if you use strict assumptions, you end up with, a fair value of $28.36. There's a lot of extra value there. So to me, Pfizer looks like a pretty good deal. Now we're looking at Merck, and with Merck, again, dividend next year $2.60, discount rate of 6%, and assuming they can grow at a little bit of a higher rate, they've got the lower payout ratio for Merck. They've also got more growth in revenues compared to Pfizer, so I went ahead and went with a 2.5% growth rate. That would give you a fair value of $74.29. Not a good deal, and these are, pretty generous assumptions here. I mean, if I want to use a higher discount rate, that knocks it all the way down to $57.78. Okay, so if I put the 6% back, and if I say, okay, you can only grow at 2%, that knocks it down to $65. So for Merck, it doesn't look like a good deal. I would like to see the fair value be, at least reasonably close to the stock price for me to want to buy. Last thing to check is insider trading. The insiders often know more than we do, and so we might be able to get some information there. Pfizer has more insider sales than purchases in the last 3 months and 12 months. When we look at the number of shares involved, there's definitely a lot more sales than buys here. And that's overall a bad sign going forward. Now for Merck, it's pretty similar. You've got no one buying in the past 3 months, 5 sales transactions, and it's a fairly significant number of shares there with a little over 500,000 sold in the past 3 months. So also pretty negative indicator for Merck. Alright guys, so here are my final thoughts on Pfizer versus Merck. When you look at the dividend discount model, clearly Pfizer is the winner there. Both companies are profitable, both companies have pretty good dividend yields and a respectable record of dividend growth. So they're nice, stable investments. I like to have some dividend stocks. When they go down in value, at least you can just hang on to them and get those dividends. That is comforting. That being said, both companies, when you run the numbers, it's really not that good of a deal. To me, it's not significantly better than the alternatives, like just putting your money into the stock market index in general. So if you're going for above market returns, and that's very important to you, I'm not really sure that either one of these stocks is going to be a good one for you. But if you're just trying to build a diversified portfolio and you want some stability, some kind of regular dividend paying stock, I think Pfizer is going to be your one over Merck. So those are just my thoughts. Let me know what you guys think in the comments below. Thank you for watching.